Welcome back, everyone, for another deep dive.
This time we're tackling a classic,
Oh, yeah.
The Intelligent Investor by Benjamin Graham.
A must-read.
It's like the OG guide to investing,
Yeah,
not speculating.
absolutely.
And whether you're just starting out in the market or you've been around the block a few times, Graham's wisdom is seriously timeless.
He honed these ideas during some pretty wild market swings, too.
Oh yeah, like surviving crashes and all that.
Exactly. And then you've got the whole mentored Warren Buffett thing.
Right. As a certain cool factor.
Definitely.
So I think what's so cool about The Intelligent Investor is that it's not some, dense finance textbook.
It's really not.
It's more like a blueprint for thinking clearly about the market.
That's a great way to put it.
And avoiding those emotional traps that can lead to some bad decisions.
Oh, yeah, we've all been there.
Right. Like that urge to panic sell when things dip.
Or chase the latest hot stock tip.
Oh, for sure.
Yeah.
Which, speaking of, brings us to the title itself. The Intelligent Investor.
Right.
Doesn't actually mean you need a genius IQ.
Nope, not at all.
Right.
For Graham, intelligent is all about temperament.
Okay, I like that.
You need patience, discipline, a willingness to learn from your mistakes, and probably the most important, emotional control.
Makes sense. It's like Graham lived through some crazy times.
Yeah.
Shaped his whole approach.
Yeah.
There's this story about him and Northern Pipeline Co. back in 1925.
I love that story.
Really illustrates this point.
It's a classic. So he didn't just glance at the stock price.
Right.
He dug deep into the company's financials, like a detective uncovering clues. And what did he find? Turns out they owned a ton of valuable land, but the market hadn't factored that in.
So he spotted this hidden value.
Exactly. He saw the discrepancy, bought the stock, and made a nice profit when the market caught up.
So it's not just about picking stocks. It's about understanding the underlying value.
Precisely. And that brings us to one of Graham's core principles.
Okay.
The distinction between investing and speculating. Okay, imagine this. You have a friend who's convinced they've found the next big thing.
Oh, I know this person.
Right. This company is going to revolutionize, underwater basket weaving.
Okay, sure.
The stock is skyrocketing. Everyone's jumping in. FOMO is rampant.
Yeah, that sounds familiar.
That's where speculation takes over.
Okay.
People buy based on hype and hope they can sell even higher later. It becomes a game of hot potato.
Cool.
And someone's left holding the bag when the music stops.
And nobody wants to be that person.
Nope. Think back to the dot-com bubble.
Ooh, yeah.
Companies like Juno Monument Internet Fund.
Names that bring back memories.
Everyone focused on potential growth, but ignored the basic question.
Which is
the current price justified by the actual business?
Right. And those who bought into that hype.
Paid the price.
So how do we avoid falling into that speculation trap? What does true investing look like, according to Graham?
Well, for Graham, investing is about thoroughly evaluating a company's intrinsic value. What the business is actually worth based on its assets, earnings, and future prospects.
So you're saying we need to be more like home inspectors than house flippers.
Exactly. And once you've done your homework, you only buy if the price is significantly lower than that intrinsic value.
Got it.
Giving you a margin of safety.
Ooh, we'll get to that later.
Yes, we will. Now, to help navigate this, Graham outlines two approaches.
Okay.
Defensive and enterprising investing.
Right, because not all investors are the same.
Exactly. Different personalities, different time commitments.
So you've decided to become an intelligent investor.
Yes.
Where do you start?
Well, Graham gives us two main paths. It's like choosing your own adventure.
I love it. Tell me more about these approaches.
Well, let's start with defensive investing.
Okay.
Think of it like setting your finances on autopilot.
Autopilot. I like that.
Perfect for those who want simplicity and minimal effort.
Right.
Graham recommends a diversified portfolio, mainly through low-cost index funds, and a classic 50-50 split between stocks and bonds.
Right, that 50-50 split is classic, but can it be tweaked?
Of course.
Based on, market conditions or someone's risk tolerance?
Absolutely. It's a starting point, not a rigid rule.
Okay.
If the market feels a little frothy, you might tilt more towards bonds.
Makes sense.
And speaking of bonds,
yes,
they're not all created equal.
Right.
You've got tax-free municipal bonds, corporate bonds with varying levels of risk, and maturities ranging from short-term to long-term.
Okay, so even autopilot requires some initial setup.
It does.
But what about those of us who enjoy tinkering under the hood? Maybe willing to put in some research time for potentially higher returns.
That's where enterprising investing comes in.
Right. So tell me about that.
It's for the more hands-on investor,
Okay.
actively searching for undervalued companies.
Like hidden gems the market's missing.
Exactly. Graham lays out 4 key areas to explore.
Okay.
First, buying low and selling high, which sounds simple, but
Easier said than done.
right, then finding growth stocks with solid potential.
Got it.
Uncovering bargain issues priced below their true worth.
Okay.
And capitalizing on special situations like mergers.
That Chrysler example in the book really stood out to me.
Table 7-3.
Yeah, their stock price was like a roller coaster.
It was quite a ride.
How can the same company look like a steal one year and then overpriced the next?
It comes down to understanding the factors that drive a company's value.
Okay.
It's like a puzzle with pieces constantly shifting.
Because of?
Market conditions, industry trends, and the company's own performance.
So an enterprising investor has to analyze all these moving parts.
Precisely.
That's where Graham's security analysis comes in.
Right.
Right.
He provides a framework.
But this is where it gets a little overwhelming for me.
I understand. It can seem daunting at first.
Yeah.
But Graham breaks it down into manageable steps.
Okay, good.
Let's say we're looking at a company called Techie Gadgets.
Okay, I like it.
First, we'd examine the earnings record. Are profits consistent or all over the place?
Got it.
Next, we peek at their balance sheet.
What is that?
Think of it like a financial snapshot, a pie chart.
Okay, I'm visualizing a pie.
One slice shows their assets, what they own.
Mm-hmm.
Another shows their liabilities, what they owe.
Okay.
And the remaining slice is their net worth or equity.
What are we looking for in those slices?
We want to see a healthy balance.
Okay.
Are assets mainly cash and valuable equipment
Or?
loaded with hard-to-sell inventory?
Got it.
And are their liabilities, like loans, manageable compared to their assets? Graham gives us specific ratios,
Right.
like the current ratio. It tells us if a company has enough short-term assets to cover its debts.
So basically, can they pay your bills?
Exactly.
So a high current ratio is good.
Generally, yes.
What else?
We also need to scrutinize their management.
Okay.
Are they efficient? Do they communicate well with shareholders?
How do we assess that?
It requires looking beyond the numbers,
That's-
understanding their track record. Do they act in the best interests of the company?
Right. And its shareholders.
Exactly. This reminds me of the company analyses in Chapter 13.
Oh, yeah. He breaks down real companies.
He does.
It's not just theoretical.
Right, like the analysis of Emerson Electric.
Yeah, he highlighted their consistent earnings,
And strong dividend record.
which are signs of a well-managed company.
Exactly. Those case studies are so helpful
They show how to apply the principles.
in the real world.
So security analysis is like being a detective.
It is. You need to adapt your approach,
Based on.
the industry, the company's growth stage, and your own goals.
But even with all that research, the market can be unpredictable, right?
Absolutely. That's why Graham stresses margin of safety.
Okay, I'm intrigued. Tell me more.
Imagine you're buying a used car worth $10,000,
Okay,
but the seller is desperate and offers it for $6,000.
that's a steal.
Right? That $4,000 difference is your margin of safety.
Okay, I see where you're going with this.
Even if something unexpected happens, like it needs a repair.
You're still good.
Exactly.
Yeah.
You bought it below its true value.
So how does that apply to investing?
The margin of safety is the gap between the price you pay for a stock
Okay.
and the company's intrinsic value.
So we're not just buying a good company.
Nope.
We're buying it at a great price.
Precisely, like the Washington Post in April in '73.
Ah, yeah. He saw the market was undervaluing their assets.
Newsweek TV stations.
It was a phenomenal investment.
Textbook example. A healthy margin of safety cushions us.
Run!
Market volatility. And our own errors in judgment.
It's like a buffer,
It is. It protects us from overpaying for growth.
which Graham warns against.
Yes, he uses that philosopher's stone analogy.
Right. Appendix 4.
Alchemists obsessed with turning lead into gold.
And some investors are like that with growth stocks.
Exactly. They'll pay any price.
But even promising companies can stumble.
They can. And overpaying leaves no room for error.
So we've covered a lot.
We have.
The intelligent investor mindset, defensive versus enterprising investing,
Right.
security analysis, margin of safety.
Important stuff.
But Graham doesn't want us to just be passive.
Right. No, he encourages us to be active owners.
Hold management accountable.
Absolutely. We're not just buying stock certificates.
Right. We're becoming part owners.
Exactly. With a right to ask tough questions and make sure they're working in our best interests.
So we're not just passively riding along. We have a say in how the car is driven.
That's a great analogy.
What are some questions we should be asking?
Well, in Chapter 19, Graham gives us a list of probing questions.
Okay, like what?
Is management truly efficient in allocating capital?
Okay.
Are they focused on long-term value creation or short-term profits that might hurt the business later?
Got it. What else?
Are they transparent in their communication with shareholders?
It's like being a detective again, but this time investigating the people running the show.
Exactly. And this all ties back to that Enron scandal.
Oh yeah, a chilling reminder of what can happen.
When conflicts of interest run rampant.
And shareholder value is ignored.
Absolutely. Enron's collapse was a stark lesson.
In the dangers of unchecked greed.
And a lack of accountability.
It really underscores why shareholder activism is so important.
Even on a small scale.
Okay, we've covered a ton of ground today.
Yeah.
From the intelligent investor mindset to defensive and enterprising investing.
Right.
Security analysis, margin of safety, even shareholder activism.
It's a lot to digest.
It is. So for our listeners out there venturing into the investing world, armed with Graham's wisdom, what are the key takeaways?
Well, whether you're drawn to the autopilot of defensive investing or the hands-on approach of enterprising investing, Graham's principles apply universally.
Okay, I like that. So what's the first one?
Emotional discipline is far more critical than a high IQ.
When it comes to
navigating the market's ups and downs.
Right. Emotions can get you into trouble.
They can. What's next?
Number 2.
Always differentiate between investing and speculating.
Investing is
grounded in thorough analysis.
And speculating
is essentially gambling.
Got it. Number 3.
Consistently seek that margin of safety.
That buffer.
Exactly. Protection from the unexpected.
And finally,
don't underestimate the power of being an active owner.
Hold management accountable.
Yes. Make your voice heard.
It's amazing how relevant these ideas still are.
I know, right? Decades later.
So here's the million-dollar question for our listeners.
Okay.
What's one specific action they can take today?
To become a more intelligent investor.
To put all this into practice.
That's the key, right?
Yeah. Should they open a brokerage account?
That's a good step eventually.
Buy an index fund.
Could be part of a defensive approach.
Or try to calculate the margin of safety on a company they're watching.
That's a great idea. Actually, I have an even better first step.
Okay, I'm all ears.
Grab a company you're already interested in.
Okay.
Maybe one you own shares of.
Got it.
Put on your intelligent investor hat.
Love it.
And analyze it using Graham's framework. Really understand their business model, dig into their financials, earnings history, debt levels, cash flow.
Got it.
Then try to estimate their intrinsic value.
Is it really undervalued?
Exactly. Does it offer a margin of safety?
This exercise will really bring it all together.
It will. You'll be putting everything we've discussed into practice.
Awesome. A concrete action plan for our listeners.
And once you've done your analysis,
yes,
we'd love to hear about it.
Absolutely. Share your insights, your aha moments,
your investment journey
with us on social media or drop us an email.
I love hearing from you.
And until next time, happy investing.
Happy investing.
And remember, stay curious, stay informed,
and above all,
stay intelligent.
As Benjamin Graham wisely said, the intelligent investor is a realist who sells to optimists and buys from pessimists.